There's so much to run through here, but maybe first front and center is this idea of these two realities that are kind of crashing into each other right now. The first is limited supplies and Russia shutting down things, making the energy markets so tight. The other, though, is this looming global recession because central banks are tightening so quickly. How is this playing out?
Well, let's start with the European energy crisis. I like to point out, I've been doing this 30 years. I've never seen a forecasted energy crisis actually materialize. You don't get hit by the train you see coming at you. You've got inventories quite high at this point in time. You've done a lot of demand destruction on the industrial side. We see it in the aluminum and metal side of the business. On our target for European gas, by first quarter is going to be sub 100 euros per megawatt hour. And by the way, I go back to the energy crisis in the U.S. in 2000, 2001. Gas went up to 10 and then round trip right back down to $2 an MMBTU because you lost so much industrial demand. Guess where all that industrial demand went? Europe. Now it's likely going to come back to the U.S. But that aside, I think really what's going on in the oil market more broadly is you have the market having created slack with the weakness around the concerns around energy crisis in Europe and the lockdowns or zero COVID policy in China. And when you have that slack in the system, the market's essentially trading off the dollar, kind of which brings you into the, what the Fed is doing and how the dollar is reacting. And we think about when did it disconnect from the dollars when you had really tight markets earlier this year. So we would think as you move into the winter, oil begins to get tighter. And I think the big event with oil is, the price cap in the EU ban as you get towards the end of this year. And you're likely to lose significant amounts of Russian supplies going into the West. Because I like to point out when you transition, redirect that supply, it's not frictionless. You're going to lose somewhere around 30% of the supplies that get redirected. We think at that point, this market in oil starts to get really tight. Plus, no SPR oil at that point in time. Rig counts are going down in the U.S., no Iranian deal. And we look at Saudi Arabia. It's operating at, 11 million barrels per day, so not a lot of spare capacity in the system.
Hey, Jeff, let's just go back to this UK idea of price caps. They're not really price caps. They're price caps on what businesses and consumers will pay in the UK, but they're going to have to find some way to pay for it because they can't control the cost. Does that mean that they're going to be printing money? Does that mean they're going to be raising taxes on somebody other than businesses and consumers?
That's why the pound sterling's at 1.14, 1.13. You're at 37-year lows on the pound sterling because people don't know where that financing is likely to come from, and the numbers are very large, like COVID-esque style of
like 40 billion
type
pounds.
of stimulus. And so right now it's being priced into the pound sterling, and as we go through, we'll find out how they actually are going to try to finance this. But I think it's adding to the dollar strength in both the euro, because we've got a similar dynamic playing out in Europe. That's what's putting a lot of that downward pressure on oil prices right now, because the dollar is so strong. If you don't have the physical tightness in oil that's grinding it into a physical market, the marginal buyer is the financial player, and they're trading off that dollar, which is creating that weakness.